So, is the stock market safe? Today, I'm going to share my insights on the stock market and possibly answer this question for you. So stay tuned. Welcome to Wealth Generation Strategies, and I'm your host, Frank Thomas. Today, I want to unpack the question, is the stock market safe? With all the advice flying around on stock market crashes, we're in a recession, wild stock windfalls, woohoo, that's in the sky, and news in general, it makes this question extremely valid. I'll be talking directly about investing into the stock market in this video, so please remember that I am not a financial advisor, and I'm not giving you financial advice. It's important for you to do your own research and make your own personal determinations. Got it? Good. Before I dig into this topic, let's make sure we all realize what the stock market really is. Any and all stock markets are based off a collection of stocks or shares to companies that have become publicly registered. There are a lot of other financial vehicles like commodities, forex, options, futures. Wow, the list is practically endless when it comes to the stock market. But what we care about today, though, is company shares. In some ways, this is one of the safest playgrounds in the stock market. Also, it's a great place to learn about investing in the stock market. Now, I see three most simplistic ways anyone can invest into stocks is to either purchase the stocks that will eventually increase in price, stocks that pay out dividends, or maybe a bit of both. When I started my adventures in the stock market, I invested into good companies offering reliable and increasing dividends over time. Dividends, by the way, is a form of profit sharing a company can participate in. Whether they do it monthly, quarterly, or yearly, they offer a share of the remaining profits that their company has generated in the form of cash dividends, and we all love cash. In essence, I'm more of a dividend investor than a growth stock investor. The reason I chose this route is because I don't want to worry about inevitable rises and falls of stock prices. Moreover, I started my dividend investing with Dividend Aristocrats and Dividend Kings. The former has issued dividends continuously for at least 25 years, and they either have stayed the same price or raised. The latter have been doing the same thing, but for 50 years. Also, I believe in investing into good dividend companies that have evergreen products. One example is Procter & Gamble. Procter & Gamble, hey, I bet you the shampoo you use comes from Procter & Gamble. Another is Coca-Cola, and we all know what Coke is around the world. Great dividend king. There are a ton that you can invest into, but there's one failing with Dividend Aristocrats and Kings. They normally don't really have a fantastic dividend rate. It's not unusual to find these types of stocks will pay anywhere from 1 to 5% of profits. If you wish to become financially independent on dividends of these types of stocks, you'll have to purchase a lot of stocks or hold them for a long time. As I mentioned earlier, there's a lot of different things you can invest into. One is to invest in what is called exchange traded funds or ETFs. Now, simply put, an ETF is a basket of stocks from various companies in some sort of sector in the stock market. So same stocks, but within a basket. A great example of a US ETF is SVOL, S-V-O-L. It has a collection of stocks in it from the S&P 500. This offers more diversification to your portfolio. If you look at the average dividend return of SVOL, it can float around 16%. You must be wondering now, how is it that the S&P 500 has an average return of about 10% a year, but SVOL is offering 16%? Where does the extra 6% come from? Well, simply put, ETFs can employ a few strategies to increase dividends. One is to leverage the portfolio. When they leverage a portfolio, they will use the value of the portfolio as a whole to borrow more equity to purchase approximately 20 to 30% more in stocks than the portfolio is worth. This will immediately add an extra 2 or 3% to the dividend because you have extra stocks contributing to that whole. Next, they can also sell options on the stock portfolio, this again taking the profits from the options and adding it to the dividend. These methods will definitely increase the overall volatility and price of the ETFs, but also really increase the percentage that the dividend payout presents. One thing I don't like about ETFs, though, is that they're fairly new, and there's no ETF aristocrats or kings, okay? For example, SFAL has only been around for about 4 years or so. So we don't have a long track record to look back on like a dividend king, which is 50 years. Also, you're depending on the financial institution managing the ETF to be ethical and employing good business practices. Going with an institution that has only been around for a short period of time with a really new ETF on the market definitely makes investing in that ETF much more risky. One thing though is the ETFs do make the stock market safer to invest through is because of the fact that they're well diversified with a basket of good stocks from multiple companies. Employing the methods mentioned earlier, they can also provide a pretty good return. One method I use to help mitigate my overall risk within ETFs is to invest into markets from different funds managers. Nothing is worse than investing into a fund company that goes bankrupt and thus your money disappears. I've played that game in the past outside of the stock market, so now I avoid it while being in the stock market. I don't like this risk at all. This goes back to the fact that the stock market is publicly traded funds. There should be and is more regulations and policing of this form of investment, hence making it a lot safer. Before continuing though, if you want to take the next step and get even more information from my research, be sure to check out a link in the description below where you can sign up for my newsletter. You're going to get lots of great information from it and links and information and extra stuff that's just not in the video. It's absolutely free and I'll be sharing a lot through this newsletter. But if not, be sure if you're enjoying this video to give it a like and hey, consider subscribing. It does help the channel out. In regards to my portfolio, I did start out exclusively investing into great dividend aristocrats and kings. I'm in my 60s now and I need to find ways to enhance my return on investments. So I have opted into purchasing more ETFs. Right now, I have a fairly balanced portfolio containing great stocks and ETFs. I'm seeing an average return across my portfolio of about 12%, which is pretty darn good. But let's wrap up today by definitively answering our initial question. Is the stock market safe? The stock market is like any other tool you use in life. If you don't know how to use a hammer properly, it can be a dangerous tool. If you don't understand the stock market, again, it can be a very dangerous tool to your investment efforts. So you've got to get to know the stock market. My recommendation is to make initial small investments into different great stocks and get the feel of them. Over time, and as you learn more, you'll soon be able to increase your earning potential. Again, look at your dividend aristocrats, your dividend kings. Now, I've only talked about the investment style I employ, and that's dividend investing. You can purchase great growth stocks that may not have dividends, but still provide great returns in the overall increase in stock price. Companies like Microsoft and Apple come to mind. Warren Buffett has made a fortune off of both of these stocks. And I'd like to share you with one more really important fact. Learn to invest into any type of investment with your brain and not your heart. The stock market, for example, will go up in price and down in price and sideways. Overall, though, if you've purchased good stocks from good companies, they will increase in value over time. You got to remember that the stock market can be a lunatic, so you just got to know that. The minute you become emotional in your stock trading, you will lose money. I love what Warren Buffett says. He says, I will tell you how to become rich. Close the doors, be fearful when others are greedy, and be greedy when others are fearful. And take a few minutes to learn more about the stock market before you put all your eggs into the stock market basket. Right now, you should see another video showing up on the screen that talks a lot more about investing. It's a really interesting video. I'm sure you're going to enjoy it, so take a peek at it. If not, thank you for joining me today, and I hope you have enjoyed this video. And hey, the stock market isn't bad. Give it a try. Frank Thomas here. We'll talk to you there. Bye-bye.